Become rich with index fund investing. Unlock the doors to financial freedom with our latest video, Become Rich with Index Fund Investing. Ever wondered how to make your money work for you without the headache of stock picking or market anxiety? Today, we're demystifying the secrets of index fund investing, your ticket to stress-free wealth building. Don't miss out on the key findings and expert insights. Whether you're a financial novice or seasoned investor, it's never too late to embrace the power of index funds. Hit play, join the conversation, and let's pave the way to financial success together. Have you ever dreamt of sipping piña coladas on a beach while your money does all the hard work for you? Well, what if we tell you there's a secret sauce to wealth building that doesn't involve complicated stock picking, constant market watching, or sacrificing your sanity to the Wall Street gods? Picture this, a strategy where your money grows steadily like a well-tended garden without the roller coaster ride of individual stock prices. Curious? Intrigued? Ready to discover the path to financial freedom through the world of index fund investing? Stay tuned, because today we're unraveling the mysteries, debunking the myths, and laying out the roadmap to help you become rich with index fund investing. What is index fund investing? Investing in index funds is like putting your money into a bunch of stocks or bonds that follow a particular market index. Instead of trying to outsmart the market, index funds aim to copy the performance of the index they're linked to. This approach keeps things simple and less risky. It's a good choice, especially for those just starting to dip their toes into the world of investing. The cool part? Index funds don't cost a lot, making them a budget-friendly option for beginners. It's like having a piece of the market action without the stress and expense. Some of the most popular market indicators that index funds follow include S&P 500 Index. It keeps an eye on the 500 biggest companies in the United States. Dow Jones Industrial Average. It watches 30 large U.S. companies. NASDAQ Composite Index. It follows all stocks listed in the NASDAQ Stock Exchange. Russell 2000 Index. It tracks the 2,000 smallest companies traded publicly in the United States. Total Stock Market Index. It monitors all publicly traded stocks in the United States. Now, there are two main kinds of index funds. We have mutual funds and exchange-traded funds, ETFs. Mutual funds are traded only once a day, while ETFs can be traded throughout the day, similar to stocks. Why invest in index funds? Actually, index funds come with several benefits. First, they usually have lower fees compared to actively managed funds because they work passively, just tracking a market index. This means they don't need expensive teams for analysis, keeping costs down. Another advantage is broad diversification. Index funds invest in a variety of stocks or bonds, reducing risk. If one investment doesn't do well, others in the fund can help balance it out. They are also more tax efficient. Index funds trade less frequently, resulting in fewer capital gains distributions. This can lead to lower taxes for investors. Transparency is another key feature. Investors can easily see which stocks or bonds the fund holds and their weights in the portfolio. This openness helps investors make informed decisions. Lastly, index funds are simple to invest in and manage. You can buy and sell them through most brokerage accounts without spending a lot of time researching individual stocks or bonds. This simplicity makes them suitable for investors of all experience levels. Overall, index funds offer advantages like lower costs, better tax efficiency, diversification, transparency, and simplicity compared to other investment options like actively managed funds. Hey, before we continue, we want you to know that we're always making new content, so make sure you like and subscribe to our channel so you don't miss anything. Now, here's a list of some really good index funds in the United States based on how well they did in the last year up to August 4th, 2023. Fidelity Zero Large Cap Index Fund, FNILX. This one follows the Fidelity US Large Cap Index, which includes the 500 biggest public companies in the US. It's super cost-effective with no expense ratio. Vanguard S&P 500 ETF, VOO. This ETF keeps track of the S&P 500 Index, the most watched stock market index globally. It's one of the cheapest S&P 500 ETFs with an expense ratio of 0.05%. SPDR S&P 500 ETF Trust, SPY. Another one following the S&P 500 index that's quite popular worldwide and has an expense ratio of 0.0945%. iShares Core S&P 500 ETF IVV. Like the previous ones, it also tracks the S&P 500 index and is a low-cost choice with an expense ratio of 0.03%. Schwab S&P 500 Index Fund, SWPPX. This fund also follows the S&P 500 index and is available through Schwab. It's one of the cheapest with an expense ratio of 0.02%. Shelton NASDAQ 100 Index Direct NDAQX. This one tracks the NASDAQ 100 Index, which includes the 100 biggest non-financial companies on the NASDAQ Stock Exchange. It has an expense ratio of 0.19%. Invesco QQQ Trust ETF. QQQ, tracking the NASDAQ 100 Index. It's quite popular and has an expense ratio of 0.2%. Vanguard Russell 2000 ETF. VTWO. This ETF follows the Russell 2000 Index, which includes 2,000 smaller public companies in the U.S. It's relatively cheap with an expense ratio of 0.07%. Vanguard Total Stock Market ETF, VTI. This ETF tracks the CRSP U.S. Total Market Index, a broad index of all publicly traded U.S. stocks. It has a low expense ratio of 0.03%. SPDR Dow Jones Industrial Average ETF Trust DIA. This ETF tracks the Dow Jones Industrial Average, which includes 30 large-cap U.S. companies. It has an expense ratio of 0.16%. Remember, how well these did in the past doesn't guarantee future success. Before investing, think about your goals and how much risk you're comfortable with. Now that you know everything about index funds, the question now is, when is the best time to start? Now is the perfect moment to begin putting your money into index funds. These funds are a smart way to invest for the long haul. And the sooner you start, the more your money can increase over time. Sure, the market can go up and down and there might be moments when it's not doing well, but historically, over a long period, it generally goes up. So if you invest in index funds and hang on to your investments for a while, you're likely to see good returns. Here's why it's vital to start investing in index funds early. Compounding returns. This means your money grows faster over time, especially when you reinvest your earnings. So the earlier you start investing, the more impact compounding returns will have. Dollar cost averaging. It's a strategy where you invest a fixed amount regularly, no matter what the market is doing. This helps lower your risk by spreading out your purchase price over time. Time horizon. Index funds are for the long term. Plan to invest for at least 5 to 10 years or even more. The longer you invest, the more your money can grow, increasing the chances of positive returns. If you're new to investing, index funds are a fantastic way to begin. They're a cost-effective, diverse option suitable for investors of all levels of experience. Now, there is this Schwab study that they have conducted. So what is this study all about? The Schwab study done by Charles Schwab in 2022 looked at how index funds and actively managed funds performed. It found that in most cases, index funds did better over a long time. They checked over 10,000 mutual funds and exchange-traded funds ETFs for 20 years. In 88% of all types of assets, the average index fund did better than the average actively managed fund. The study also saw that index funds were better for taxes than the actively managed ones. This is because index funds don't trade as much, leading to fewer capital gains distributions. This study strongly suggests that index funds are a smart choice for many investors. They are affordable, diverse, and good for taxes, especially for those planning for the long term. Index funds have a history of doing better than actively managed funds. Here are the key findings from the Schwab study. Index funds usually did better than actively managed funds over the long term. Index funds are better for taxes than actively managed funds. The cost of actively managed funds can hurt how well they do. Index funds are a good investment choice for many investors. For those thinking about index funds, the Schwab study is crucial. It gives more proof that for many investors, index funds are a good choice no matter their risk tolerance or goals. Now, when can we say that it's too late to invest in index funds? It's never too late to put your money in index funds. These funds are a smart long-term way to invest. The earlier you start, the more your money can grow. Even if you're already retired or getting close to it, you can still benefit from index fund investment. Here's what index funds can do for you. Generate income. Index funds can make money for you through dividends and gains. This extra income can add to what you get from your retirement. Preserve your wealth. Index funds can help you keep your money safe from inflation and market changes. Grow your wealth. Historically, index funds tend to go up over a long time, so if you invest in them and keep your investments for a while, you'll likely see good returns. Hey there, before we reveal the top tips when planning to invest in index funds during retirement, make sure to tap that subscribe button and turn on the notification bell. This way, you won't miss out on our newest videos. You can decide if you want notifications for just a few videos or all of them. It's your choice, and if you're using your phone, don't forget to enable notifications in your settings. If you're thinking about investing in index funds during retirement, here are some tips. Check your risk tolerance. Understand how much risk you're comfortable with before investing. This depends on things like your age, income, and expenses. Diversify your investments. Don't put everything in one place. Invest in different index funds that follow various markets. This lowers your risk. Adjust your investments regularly. Markets change over time. To keep the balance you want, you might need to sell some winning investments and buy more of the ones that didn't do as well. Use tax-advantaged accounts. If you can, invest in index funds through accounts that give you tax advantages like a 401k or IRA. This can save you money on taxes. Investing in index funds is a smart way to grow and protect your money during retirement. By following these tips, you can pick the right index funds for you and build a diverse set of investments to reach your retirement goals. Now that you've got the keys to the index fund kingdom, it's time to take action. When it comes to securing your financial future, we want to know, are you planning to start your index fund journey right away? Or are you still contemplating the leap into stress-free wealth building? Let us know in the comments section below, and as always, don't forget to hit that like button if you found this video helpful, and subscribe to our channel so that you never miss out on my latest content. And for more resources and links related to today's topics, be sure to check out the description below. Thank you for watching, and we'll look forward to reading your comments and engaging with you in the next video.